Good morning. Uncles are here. Yeah, we are not that old. Let's give 10 minutes, 5 minutes only, because I want to respect your time, the people that show up early. Can you see the screen? It's good. Okay, amazing. It was a nice week. Okay, well, so let's begin with the review. Okay, so some of you were asking me how do I manage all the layouts and the drawings. I basically have different screens for everything that every gap, different temporally time frames. You want to think like, for example, like what the time frame alignment that ICT teaches on the core content. If you think, for example, that a new month opening gap, it's a monthly PD array. If you want to see it like this, I always look at the daily chart for the new month opening gaps and the levels that I told you. Basically, we are considering the every monthly new month opening gap and the previous month. So we have, for example, in this case, we don't have, because we open for 3 months basically in the same levels here. So below the new month opening gap, we are going to consider in close proximity the previous month, and we are going to draw our 75, 50%, and the 25% of this. So we have the event horizon 25 and the 75% and 25%. So above the marketplace, once we are leaving the new month opening gap, that it's the actual from February here, I am anticipating the external liquidity. So we measure new month opening gap to external liquidity, and we are going to have quadrants to reach the external liquidity here, all-time highs. Okay, so we are using these areas as a pivot levels to anticipate if we are going to continue to move higher or lower, and see how the candles are respecting the key levels or key zones inside of the gaps and these areas. Here, for example, we never close below the 75% here, not a single candle. Okay, so you can see how this was Friday, Monday, we have this new week opening up that it's another chart that I will show you, and then we close above the 75%, and we were respecting with bodies this level. We were trading inside of this range. Then, and on the high impact news on Wednesday, we took the previous day low and we tapped into the new month opening gap. We repriced here. I was anticipating to see if we could reach these relative equal lows here and tap into the consequent encroachment here. So that scenario didn't happen. Your price move and close again, respecting this level. You see here? And on the next day, we open, reprice the level, and now we are closing above the event horizon. So we are using these levels basically and this chart and the daily chart to anticipate if we are trading in close proximity to the open, to these levels, we are anticipating if we are anticipating higher prices, we should try to long in discount relative to this level and the actual 9:30 opening. So we are aligning different openings of candles to position ourselves in a real discount level. Okay, so on this day we open, we tap, we reprice the 25%, close above the event horizon, taking this buy side liquidity, and we were anticipating that this candle is gonna create a buy side inefficiencies, a VC here. So now I told you that ideally, if we are going to move higher, we should use this new week opening gap as a new area for accumulate more positions. This is the last new week opening gap before reaching the external liquidity. Okay, here, you see? It was the last new week opening gap above the event horizon. We repriced the new week opening gap, and now we were trading towards the final quadrant before reaching the external liquidity. Okay, and ES was basically the same, but instead of using this quadrant, we were trading between the range of December open and the actual new month opening gap. So we are using like time frame alignment from PD arrays, but instead of noting like PD arrays, we are using only the gaps and the range between one gap and another. Because if you think any monthly PD array basically is, if you note an auto block, for example, this is something that when I was studying this thing for the first time, is what I realized. If you are saying like this is an auto block, what is an auto block? Basically, you are noting the new month opening gap between September and October. This is a gap in the daily chart. This is rejection block, is another new month opening gap. So instead of having like to annotate every PD array in your monthly chart for your daily chart, you use the new month opening gaps and the event horizon and quadrants between one another and external liquidity. So you don't need to go to the monthly chart at all. You just have your daily chart with the new month opening gaps and the event horizon between one each other and the external liquidity. So in this case, look, I want you to look something, it's really important. We are basically moving from fair valuation from 1 month to another area of fair value into the monthly range. So in this month, we open in February and we reach perfectly the yearly open. New month opening gap of January, taking this sell side liquidity aligned with the gap. Remember that I told you that this is the mechanism that the market uses to accumulate position. This is an offset accumulation in an area of fair value. This we tap into the new month opening gap, and now we were closing above the consequent encroachment here. So on this week, we gap lower, we take this previous day low here, and now we are closing inside of this range. We were not closing not a single candle inside of the new month opening gap. We were expecting, if you put a closer attention here, look the bodies, respecting perfectly. At first, the event horizon, we take previous day high and we close in the event horizon. The next day, we move lower, but we close inside of this range. And the next day, we move higher. So if you want to have a bias, you can basically read the daily chart and how it's closing in relation to the monthly gaps and these areas. Okay, so because we were accumulating inside of this new month opening gap and we were not closing below here, we were anticipating higher prices. And we take the buy side liquidity resting in close proximity to the new month opening gap, and we reach the 75% of this range between the new month opening gap and the external liquidity. We are going to use the same logic. So we have external liquidity 75%, event horizon 25%, and we have an implied range for position ourselves in premium or discount in relation to this level and the daily candle open or your 9:30 opening for intraday. Okay, so I like the idea that we fail to reach the new month opening gap on ES. This is something that I like because I would like to see now I can trust better that price is gonna take the previous low here, and we can reach this gap, and possibly we can do something like this, reach maybe this portion of this range in the next week. But if we are going to continue to move higher, we should not close below this. I want to see candles closing of this level here. If I have a black candle printing here, I would like to see like this, not like this or like this. Now, ideally respecting the event horizon or this quadrant here, and then from here again towards the event horizon that we have buy side liquidity and we have relative equal highs. Yeah, and yeah, could be also a mere rebalance. Yeah, we can even reach the opening of this candle, but we don't want to see candles closing below these ranges here. So this is one of the layouts that I use. On this layout, basically I only have swing points from the daily chart, like buy side liquidity, sell side liquidity, and the monthly opens of every month. So, but the important thing here is where you are in relation to the monthly opening, the dealing ranges or the range quadrants, whatever you want to call it, and external liquidity. So you are going to see how in lower time frames we are going to use other gaps to accumulate more. This is something really important because as you can see here in the daily chart, all gaps are areas for where price accumulate more. And remember that during the week I told you that we saw that on the new week opening gaps, all the major swings on the hourly chart or the 15-minute chart were made inside of the new week opening gap. So basically what the market is doing is accumulating in old gaps and distributing to another gaps or outside of the range to external liquidity, like what ICT mentions, like an imbalance to all highs. But instead of considering like a regular imbalance, we are framing or trades with gaps. It's better because time-based gaps are true liquidity voids, and a liquidity void is where an area where price was not traded because the market was closed or we have an event. So these areas are stronger areas of like magnets for price, true draws on liquidity for price. And instead of having like, because you can have, if you annotate every PD array of in your daily chart, you are always have like a very messy chart. So I prefer to have it like this. For me, this is beautiful. I don't need anything else. So, and then I have here like the daily chart, and then I have the hourly chart from both assets. This, so you can see here on the high impact news during CPI, we reach the consequent encroachment, and I was expecting to see if we can run these sell stops here on Nasdaq, but we had a gap divergence. That's something that I've been telling you to look not only in the regular trading hours gap, but also in these gaps like new month opening gaps or even new week opening gap, as we are going to see later on this review. So we reprice the consequent encroachment of this new month opening gap while Nasdaq was trading basically just at the high here, and we had another new week opening gap here, the consequent encroachment. You see how it was perfectly traded here at 50%. So this is a kind of an SMT. Even if we fail, you see the structure, in the structure this is the same because both were respecting this low. But if you measure the strength based on where the asset is trading in relation to the monthly open or its new month opening gap, this is telling us that Nasdaq is stronger because it's failing to reach the 50% of the new month opening gap. So once, for example, you have an hourly candle here closing inside of this, rejecting this new month opening gap, your next draw liquidity should be the next quarter of the range. You see, you have a swing formation here on the hourly chart inside of an area of fair valuation that is the 50% on ES, and the opening on Nasdaq. Then the next draw is this level. So, and the other video that I told you is you look for anything, any PD array that it's aligned in close proximity to this quadrant. So we have this buy side liquidity, or if you want to consider this as an order block, you can do it if you want, like this. But basically, you can trust that price should reach this area here. Okay, so now prices leaving, taking these buy stops here, and on the next day we are opening really close to the event horizon. We open, we reach the event horizon, retrace, and then reaccumulate more inside of an area of fair value. Where is fair value? In a new wick opening gap. So basically we should look for trades in really close in proximity to these levels. So you see how we are trading above the event horizon and we reach the new wick opening gap. That's what I told you, that we should look for take partials always when we reach these kind of gaps, even if you are bullish, if you are expecting price to continue to move higher, because you don't know once price reach this gap if we are going to trade above and respecting and use that as a pivot point and continue to move higher, or basically we reach the gap and then retrace into the open again, and you can be stopped out at break even, or even you can even take a loss, basically, because you are not considering this area, these gaps. Okay, so now this is the hourly chart and the daily chart. So you can see, you want to see how the candles are closing, every hourly candle, basically how you are trading. So I have one monitor with this layout only all the time, and in the same monitor I have the Trinity. It's basically to look for the correlation on regular trading hours with the three assets here. And the other monitor that I use, so I told you that monthly and daily. Okay, so now we are going to consider like the new wick opening gap as a weekly PDRA, if you want to call it like that, because every breaker on the weekly chart is a new wick opening gap. Every order block on a new week on a weekly chart is a new wick opening gap. Every PDRA that is annotated in your weekly chart is gonna be the foundation. It's because it's around the fair valuation of the new wick opening gap. So you want to have those levels in your chart. So if you don't want to have like everything in one chart, you want to have a very organized way to see like a top-down analysis from the monthly fair value in your daily chart, and then you are using the hourly to monitor the daily chart, and then we are going to use the new wick opening gap but on a lower time frames. ICT says that we are using like daily and monthly, daily, and for the weekly we are using like the 4 hour and the 15 minutes, but I prefer to use only like new week's opening gaps and the 15-minute chart. I don't use like the 4 hour candle, like I don't monitor that candle. I like the hourly and the daily. And so now we go to this layout, and on this layout I will only have like only the new week's opening gaps, and here we are gonna see how we can compare if we are reaching an area of fair value and what ES is doing at the same time that Nasdaq is accumulating or reaching these gaps. So we see here on this day on CPI that we are trading basically at the 50% of this new month opening gap, that is true fair value from the monthly open, and in the other layout we are going to see that we are reaching, this is a cluster of gaps on the new week opening gap. This is the same gap but it's because the indicator plots it. But basically it's only this gap that I am referring to, and the new month opening gap. So we tap into the 50%, and now we are leaving the gap. And I took one short on this day because we traded into we were above of the 50% of the regular trading hours gap, and I was anticipating to reach lower prices. We didn't. Price failed, and I took a partial win. Took me out at break even, that I show you the trade. But look what Nasdaq was doing. The reason why I took my trade at break even was because we trade into the new week opening gap here, and we failed to move lower. We respect this area with bodies perfectly here. You see the candles are printing perfect, respecting the gap here. And Nasdaq was not, sorry, ES was not trading into an area of fair value here. But look, what's this day? Yeah. So the buy side liquidity resting from the news release was basically at the 50% of event rise consequent encroachment, of this new week opening gap. And we were trading. Once we are leaving this gap, we come back again and we reprice this new week opening gap, and we reach the 50% here. You can take your position here, that it's aligned with the range, the quadrant that we have. This is this area here, you see. So this is a nice area to look for a draw on liquidity. Once you are leaving the monthly open, you are targeting the quadrant of this range, and you are going to look for another gap aligned in this area. So we have the new week opening gap here. Okay. So we have new month opening gaps on your daily chart, new week opening gap in your 15-minute chart, and you want to have also, I know that maybe this is a lot for you, but once you have everything organized in your layouts, you're gonna see how easy it is to you to spot trades and look for levels. So because the new day opening gap is an area for the daily chart, we are monitoring those levels in the 5-minute chart. So we have basically only 4 time frames. We have the daily with the monthly gaps. We have the hourly chart to monitor the structure and how the candles are closing in relation to those levels. We have the 15-minute chart to look for the new week opening gaps, and now we have the 5-minute candles. Yeah, everything is here. It's on the electronic trading hours. And then we are going to have like the 5-minute chart with the new day opening gaps. Okay, so I have one monitor with these gaps here, and something really interesting is that when we reach one area of fair value of the daily chart, for example here, and Nasdaq has nothing here, but look at the left. Here we don't have a new day opening gap, while ES is doing an offset accumulation during the PM session on this day, on Thursday. We are taking the sell stops from the launch. This is the 104 live. We take sell stops from the launch hour, and at the same time is the same mechanism that I'm looking always, is a stop rate in an area of fair value, is here. And you can see Nasdaq doesn't have a new day opening gap, but we are trading in a new week opening gap here, you see. So you can trust that we should create like an opportunity to engage here. And now again, we are not having like an SMT, but we are having a gap divergence, if you want to call it like that, because you are measuring how the asset is trading in relation to the same gap. For example, here, do you see how Nasdaq is trading above this new week opening gap, while ES is just barely here at the close of this new week opening gap, but at the same time we are taking these lows and we are trading in this new day opening gap. So once you have this opportunity, you look for in lower time frames your inversion fair value gap, your fair value gap, your breaker in lower time frames, your auto block, any PD array that you want to trade. Once you have this specific price signature that is running stops while trading into a gap. It's not like a, for example, if you want to have like a here and look for a trade, you don't have anything to find fair value. So if you are looking for a trade here because you are taking the short-term low and you are trading into this order block, I prefer to wait to reach these gaps, because gaps are magnet for price. This is areas of fair value where the market is going to create a swing point. And now when we reach these levels, we are going to create a new market maker buy model. Okay, so even if Nasdaq doesn't have, like I told you, the new day opening gap, the fact that we are trading above the gaps on Nasdaq and ES is trading here without having the gaps, you are not going to see an SMT. And if you have an SMT like something in your watch list for taking a trade, like a confirmation, you want to see how price is trading in relation to the gaps. This is a better way to measure strength. So the fact that ES is trading in the gap and Nasdaq is above, this is telling me that Nasdaq is the strongest asset. The same thing that I told you, I've been telling you in the Discord, using the Trinity layout, we are measuring at the opening how the asset is respecting the quadrants of the the regular trading hours gap. Okay, so it's the same thing, but using new week opening gaps and new day opening gaps to measure the strength, how the asset is trading into these areas. Okay, so this is for the 5-minute chart. And finally, my the last thing, the last layout is my main monitor, where I can have everything in one chart, but you want to have like your first presented gap also, because the first imbalance of the regular trading hour session, I think I've been back texting that, and many of you have seen that many of the trades that I use take it's based on these levels. But we have on this monitor, I only have the 1-minute chart, the first presentation, and my indicator to see the overnight price action and the regular trading hours. So you are gonna see, look, this is something beautiful to back test. If you combine everything that I told you, you can use a really well model based on only taking trades based on the first presentation. Only when price is trading around this level, based on everything that I show you. Do you see how, for example, what model was this? Now let's review the profile for every day. This is a deceiver. The deceiver profile for me is when we partially rebalance the regular trading hours gap at the open, and then we trap traders into think that we are going to move lower, but then we reverse. Sometimes we do like a double purge, like on this deceiver profile. We move higher, then lower, and then reverse. But look what ES is doing here. Oh, sorry. We completely rebalance the gap here at the open. Nasdaq failed to rebalance the gap while ES did it. If you go to the free resources and you look for the draws that I have there to identify every profile, it was a really like small gap, but the fact that ES failed rebalance the gap and Nasdaq failed to do that is telling us that Nasdaq is better to look for longs than ES on that specific day. And you can see how we were not moving like above the gap at all on ES. We were trading like above and below and again above. So this is like a gap SMT. So Nasdaq was trading all the time above the gap. Do you see? And yes, the fact that rebalance the gap at the open, for me, when I see that signature, I know that if I'm looking for longs, I prefer to take it on Nasdaq because it's showing me strength based on the gap. Okay. So let's move on to the previous day. The same thing here. This was Thursday. We were trading above premium. We take the buy side liquidity from the news. We reach a new week opening gap here. That it was this day. This. It was here, and then reprice the 50% and continue to move higher, and we use the first presentation as a reaper here. You see both of the new week the first presented gaps here, and on this day do you see how ES completely rebalanced the gap? We reached the first presentation, close above the 50% of the regular trading hours gap. This is like confirmation that we should look for higher prices now after we tap discount and we reach an area fair value, move higher, and we reach this first presentation also here. So this is a deceiver model based on the profiles that I have. It's one of the assets fails to rebalance the gap while the other completely rebalance, and we look for a mean reversion and then trade higher because we were looking for higher prices based on the daily levels on the new month opening gaps. So lower time frames are only for confirming the structure, refining you're looking for opportunity to trade, but it's not like you are going to look in the 1 minute chart a reason to take a trade. We should look only for opportunity to engage on lower time frames based on the new week's opening gaps, gap divergence on a new week opening gap or a new day opening gap. After we do an offset accumulation, like I show you, like a stop rate in an area of fair value, this is huge. Then you go for a lower time frames, and you are gonna see how everything this is aligned with the first presented gap. It's crazy, believe me. So this was this deceiver profile on Thursday. Also, I want you to annotate remember the times that I told you that when are we creating like the law of the day based on the profiles. Here it's 9:38, and it's from when we have these profiles. It's around between 9:34 and 9:41, I think. I don't remember very well, but based on those times, based on the statistics, when we have these profiles, is around that time when we can look for a mean reversion aligned with many other things. But yeah. Yeah, look, the deception, the high and low is set between 9:42 and 10:10. Partials around 10:25 and 11:10, and the final distribution from that leg is around 11:25 and 11:37. Those stats are based on a friend of mine helped me to identify these profiles with data statistics and an AI. So we are looking for around those levels to those times to find like the low of the day or the profile that you are looking for. It's like an extra confluence for you to look for the profiles and the statistics. So on this day, this is what profile? This is a deception. What the market is doing is when the market opens, we trap the New York traders at the open, thinking that we are going to continue with the overnight move. Here, this was a news release, and you can anticipate lower prices. Like I was expecting like a deception, but with a little bit more of a I was expecting something like this. Look, I wanted to see something like this, but I was not expecting like a fast reprice of the rebalance of the regulatory RTH gap. But yeah, this was. Let me. There is a way to keep the chart in this safe chart. Let's just apply to all. Safe. Okay. Here, it was an amazing day. I remember that. Look, this is crazy. 9:30 opening, first presentation of previous day, and close above the high. Come back to the 50% of the first presentation of the actual day, and that was the low of the day. It was crazy. But look how we are considering regular trading hours arrays. That is the first presentation gap of previous day. We are not using any PD array to look for a trade. Anything. I don't look at that those anything. I look only for new wake opening gaps, new day opening gaps, and first presentations, and the other levels on the daily chart. But yeah, both of you were trading like a really, you took basically the low of the day. That's crazy. And I took that long here because I was expecting to, if we see that we can run this overnight sell stops. That was my idea for the trade. I took this trade, I told you. And we have here a new week opening up. That was my area for taking partials, and put my trade at break even. And I got stop out at break even. So yeah. So this was a deception. The deception profile is we have a really something meaningful like on the size. This day was Wednesday. The gap size on Nasdaq, look here on the table, was 241.25 of this regular trading hours gap. So it was kind of a really nice big gap on this day. And on ES, we had the same profile. The deception is we are rebalancing the gap at least at the 50%. Yeah, at least at the 50% of the regular trading hours. Once you are trading at the 50%, if you want to continue to look for longs, we should look for longs discount of the regular trading hours gap. That is the consequent encroachment. We should not look for longs. Once you leave the 50%, you are not going to look for longs above this level. That's a rule that I have, because many times price come back again to discount. So I prefer to look for a long if we are closing above this consequent encroachment. You wait for a retracement and look, for example, this was really nice. We have first presentation. We have this stop rate here, and we were trading also inside at the 50% of this new week opening gap here. So it was a reaccumulation inside of an area of fair value, and the structure is telling us that price wants to continue to move higher. You have the change in the state of delivery here, aligned with the 25%, this little line here. Tap into that little BC and move higher. So this was on Wednesday. And this was on Tuesday. This is something that when you are bullish and you gap lower in relation to the previous regular trading hour range, that's wonderful when that happens. Okay, so you take previous day low on regular trading hours, you reach fair value of previous day, consequent encroachment, and you are expecting that price rebalance the gap. This is like the same profile of the deception. Actually, on this day, on this deception profile, we had the same thing. We take this sell side liquidity from the regular trading hours gap, and we are expecting to rebalance at least the 50%. Sometimes doesn't happen like this fast. This is something that is many times you are going to see that price is engineering here and then trapping traders in shorts, and then price come back again to the gap. So that I told you, I will wait to see if we want to move lower, but no, I saw that we immediately come back here, and my opportunity to look for longs were missed, so I looked for a short above the 50% of the gap, and I took this short scalp here. So yeah, so we have another deception on Tuesday that is a rebalance of the regular trading hours gap. I hope now you are more related to the names of the profiles that I'm expecting. We basically have a breakaway gap, a deceiver that is a partial rebalance while the other does it, and then reverse. And the deception is basically you are fading the gap, and with the deceiver you are looking like the gap to support your trade. I don't know, this I think this is a better way to, if you, I don't know if you understand it well, but basically we are going to have only four profiles. One is the seek and destroy, but we don't trade that profile. The other one is the deception, deceiver, and the breakaway gap. So on this day we took this trade here, and on Monday we were anticipating a breakaway gap based on the high time frame chart. We were anticipating that we are going to continue to move higher because we reached on the previous day a new month opening gap here. So on Monday, since we are leaving the gap, we were expecting higher prices, and we are coming from a deep discount in relation to the monthly open. We're expecting to continue to higher prices. So on that day, we were anticipating that the breakaway gap is gonna hold, and some like characteristics of that specific profile is that one of the assets is gonna fail to rebalance partially the price. We're anticipating that price is gonna trade around this area on a breakaway gap. So yeah, most of the times breakaway gaps happen between Monday and Wednesday. That's something that I found out on my back testing also. Not like, this is not like a rule, but most of the time it's like what ICT said about the high of the low of the day. Between Monday and Wednesday, it's like 75% of, so it's the same thing. Okay, so once we are trading, we are anticipating a breakaway gap. Why? Because we are coming from discount, and another characteristic that I told you, when we have an offset accumulation during the last hour of trading, and we are opening above of a really key level. Let me see if I can. Yeah, we were opening not above the 50%, but many times when we are opening above of the previous regular trading hours gap, we are using this gap as a balanced price range. This scenario is another, but it was not the day. But look, we have here on ES, I told you, one of the assets is going to rebalance partially the gap. ES open, we are not anticipating to rebalance completely the gap because we are looking for a breakaway gap. So this day, for example, ICT wanted to close the gap, and I was expecting to not close the gap because we do an offset accumulation on the previous market on close, and we are opening with a huge gap on Monday, and we have a draw liquidity higher. So we were waiting. I was waiting to see an gap divergence here at the upper portion of the regular trading hours gap here. When ES was trading here and Nasdaq was trading barely at the open, here I took this trade here, and look, the first presentation of this day. We have a gap divergence structure. We have a stop rate into the new first presentation of the current day, and now we were using this candle as an order block, and I took this trade right here. And my target was the 50% of this new week opening gap. My first drawn liquidity was this price and I put that in the chart, 21, I think was 21,839. It was the first target. You have the 50% of this new week opening up and also the consequent encroachment of this regular trading average gap. So this is a nice area to take partials here between this range. And you can leave a runner if you want to close this gap. Look how once we close the regular trading hours gap of previous day here, that was the high of the day. And remember the high of the day during the breakaway gap. I think it's, look in the chart, this message here. The breakaway gap, the distribution is around 11 and 10 and 10.25. So it was basically on the macro of the 11 candle here. It was a high. So you can take your position completely out of this level because price can get choppy, and also this was Monday and we were anticipating like high impact news on Wednesday. So yeah, so this week we had all the profiles. Monday, breakaway gap. Tuesday, deception. Wednesday, deception. And Thursday, deceiver. And Friday was a deceiver. Deceiver, but also ES was doing like kind of a seek and destroy profile. Look, but you saw basically all the three profiles that I trade during this week. It was a nice week for being a gap trader. That yellow box FBG from that day looks off. No, this I don't know, but this indicator have the ability to include the volume imbalance of the gap. You see how include open close gap? So if you have like on this day a little volume imbalance, you see, if you toggle off, you are only have between weeks. And ICT said that you should consider the volume imbalance of the first presentation. That's the reason why I have like that. I don't know if that was a question. Yeah, I think it was. Yep. So I don't know if anybody has a question or wants to come to speak something to the stage. Just let me know. Look in your chart and your journal how many opportunities we had during the week based only on the first presentation. And look then if at the same time we were trading into a new day opening up and a new week opening up. You will see that basically all the most beautiful trades during this week was based on the first presentation, new week opening up, new day new day opening gaps align with these gaps. So that's a strong trade idea. See, you see, for example, on this day, as a new week opening up, first presentation, doing a macro. Then we are going to start the PM session. New week opening up, consequent encroachment of the new week opening up and previous first presentation. First presentation, new day opening gap and 50% of the regular trading hours gap. Move higher from here. At what time? 9:50. Macro. It was a tricky day here. I think Powell was speaking at 10, and market just move higher, chop and consolidate here. So look here again, new day opening gap and first presentation of previous day, and the actual first presentation was the most energetic move during that day. It was Friday previous week, so that's why I prefer to have like different layouts for all the gaps and just keep the trade execution layout. I try to keep it really simple and clean, just one thing basically, and to don't get lost in so many lines, because it's hard to read price if you have like no, it's not the same. The new day opening gap is not the same as the regular trading hours gap. Yeah, the first presentation is only from on the 1 minute, but if you are trading, I don't know what time frame are you looking for a trade? 5 minutes or 50 minutes or 5? Okay. You see? All the areas of accumulations were inside of the first 5 minutes imbalance. It's important. I don't know. It's a crazy thing that ICT give us this year, the previous year. This concept is really good. It's something that like packs trades and cold brew with the opening range. If you think like on regular trading hours, this is something that I've been doing like almost for 2 years. I was trading only arrays from regular trading hours since almost 2 years ago. In June, it's like my second years of trading the one setup for life trade setup. But I was trading only in balance from regular trading hours, but I was not thinking in only using the first one of the opening range. But it's a really nice confluence. You see, most of the trades, basically, if you took a long on Wednesday, based on the first presentation of this day, and you hold the position to the buy side liquidity, was the low of the week. Almost here. So, yeah, it's something that I consider. I'm not forcing like it should reach like this 100%. You just leave. It's something that it's hard. I don't know how to explain it, but you have to have like expectations of or try to anticipate price, but at the same time you have to keep your mind focused when you are reading price. What is price telling you? So it's a kind of takes time to being able to anticipate price and immediately recognize when price is telling you that, oh no, we are not doing what you're anticipating. You have to be able to change that in your mind and don't marry with price should do 100% this, because many times price is not gonna do what you're expecting, and many times yes it will do it, but when you are trading these lower time frames, it's trade what the chart shows you. See you, brother. Have a good weekend. So yeah, I hope this helps you from this review. I don't know if you have any more questions about this. How many first presentation? I have only 5. 1 week. See you, brother. Thank you. What did you do in the settings? Just toggle where there's a open candle, close, up, on, off, and toggle the option. You will include like the volume balance. I was looking at your old rates. So many stop hunts in fair value. Yeah. Yes, this is like secret sauce. This is when the total soup is gonna work, when you have that mechanism, the offset accumulation in an area of fair value in time, like a macro test. That's a plus setup. No, I just changed the time frame. Just put the chart on the 5 minute. That's the only thing that I did. One minute, 5 minutes. I don't know. Okay, so have a wonderful weekend. Enjoy your family. Pray God. Be thankful. And see you soon during the week. Yeah, it's recorded. I will upload it in a few minutes during the day. So stay safe.